we'll go ahead and get started, and as more people kind of jump on. But wanted to thank you guys for joining us this morning. So I'm Zoe Dinkla. I'm with the Iowa Pork Producers Association, and I'll just be moderating this webinar. So today we have Lee Schulz with us, and he is an associate professor and extension livestock economist for Iowa State University, and here to answer the "Is this a defining moment for the pork industry?" Webinar, while it's targeted more towards our ag lenders bankers, we've opened it up to all of our allied industry members to help explain why we're in this economic position that we're in. Just as a reminder, you guys will all be muted, won't be able to come unmuted, so we'll hold the questions for the end, but please feel free to enter those into the chat, and I'll make sure that Lee answers them towards the end. So the session's also recorded, so we'll make sure that we get a copy out to all of you guys so that you can replay it or watch it as you need. So with that, I'll turn it over to Lee.
All right, well, thank you, Zoe, and thank you to our attendees for joining us today. Zoe queued me up with our title being, "Is this a defining moment for the pork industry?" I don't know if I'm qualified to answer that. I'll remind you that economists are much better at predicting history than the future. But I think there is some components to what we're currently experiencing in the pork industry that really has the opportunity to shape the future going forward. Also, I think the word moment doesn't necessarily do it just as we think about the economic condition pork producers have been dealing with for over the last year, plus looking at what is to come potentially. We're looking at some very tough economic times. Now, I'll admit I'm not an avid reader of the Harvard Business Review, but I do think this quotation really does help set the stage for what we're going to talk about today. So the saying goes, "These critical defining moments are often characterized as moments of truth, but in real time, they're usually a moment of uncertainty, not clarity." And so as we look at the current situation outlook for the pork industry, very uncertain times, and hopefully this webinar today provides some of that clarity as we think about what producers are dealing with as well as where we see the situation going forward. Now, I want to highlight here first USDA's Economic Research Service, their forecast of U.S. hog cash receipts. I'll remind us that cash receipts are both the quantity of hogs being sold and the price being paid for those hogs. And so when we take that revenue side of things and look at this chart back from 1970, we see that 2023, the forecast for $27.6 billion in cash receipts will potentially be ranked as one of the highest years when we look at cash receipts. Down a bit from what we've seen in 2022, but overall, again, peaking higher than 2014. Now, the first caveat to put on these current cash receipts, and again, it's both the quantity and the price, is when we adjust for inflation. And so putting it into 2023 dollars, we see that it's nowhere near the highest year we've seen for cash receipts. And so here, 2014 certainly jumps out as a much higher year, but also what we realize in 2021 and 2022 were higher. And then we can go back several years in the late 70s where we've seen much higher inflation adjusted cash receipts for hogs. Why I start the story here, because I think there's an important distinction to make when we think about how inflation is impacting both producers. So the revenue that they're receiving, the dollars that they're receiving for their hogs is not going as far as it historically has. So even though nominally we've seen those cash receipts increase and be at some of the highest levels we've seen, we're also seeing that dollar not go as far. Then when we think about it from a consumer demand standpoint, inflation is certainly impacting demand. And so when we look at inflation, we've certainly come down from the heights of June 2022, where we've seen 9.1% inflation. I'll remind us, inflation, we're looking at year-over-year changes in the consumer price index, which is a basket of goods that consumers are paying. Now, while we've come down notably, from that 9.1% high. We're still not where at the Federal Reserve's 2% target rate. And actually, we've seen a bit of jumps here in August, September, higher than what we realized in June and July. Also realizing that this is disinflation here, as where we've seen a slowing overall in that year-over-year in inflation rate. But it's important to keep in mind that that basket of goods still remains at historic highs. The easiest way for me to explain that is if we take the benchmark year, so 1982 to 1984 is where we're benchmarking that consumer price index against, so that would be 100 in this case. And then we take what that CPI was in October 2023, $1 in October 2023 was worth 32.5% of what it was worth in that 82 to 84 period. We could further decompose this CPI into that basket of goods. So on the right-hand bottom side there, I highlight some food and even broken down further those food items. So food overall was right near where that inflation rate was for October, 3.3% compared to 3.2%. Bakery was a bit higher at 4.2%. Meat was higher at 4%, whereas we've seen poultry lower at 1.1% and dairy actually negative or see some deflation there at 0.4% compared to what we've seen in October 2022 for dairy. Now, this is the first time I'll introduce some 10-year forecasts here. We'll credit the USDA's Economic Research Service. These particular forecasts for macroeconomic assumptions were made in August 2023. So here I'll highlight what they show for the CPI. These would be annual averages. So 2023, they're expecting a 4.2% annual average. That comes off of the high of 8% in 2022. 2024, they're forecasting just under 3%. 25, 2.3%. And you'll see not until 26, 27 do we maybe get down to the Federal Reserve's 2% target rate of inflation. Now, as we've seen the Federal Reserve try to tamper down that inflation, they've used interest rate hikes to do that, right? And so we've seen interest rates, the prime bank rate here, I'll highlight maybe as high as 8.19% in 2023. Remember, these forecasts are back in August, and maybe some easing in that interest rate down a bit into 7.7. But also I want you to highlight here as we look at 10-year forecasts, nowhere near kind of the low interest rates that we've seen the latter part of the last decade and early on in the 2020 decade. Now, inflation in itself is not necessarily an issue. We have to pair that when we think about changes in real wages. So the wages that folks are earning. And I'll give you an example here. When we look at 2020, second quarter, we actually seen real wage rate growth of almost 10%. Inflation wasn't anywhere near that, right? We were seeing 0.4% inflation. So consumers were better off in that scenario. And not surprisingly, we've seen really strong demand, and that was part of the reason that has led to some of this inflation. But you've seen really that unwielding demand in 2020. Now, as you've seen adjustments both in real wages, so we've seen stagnant growth in real wages. I'll point to here the third quarter of 2023. We've seen 0.83% growth in real wages, but we've seen inflation up 3.5%. So overall, this highlights that the wage growth has not kept up with the level of inflation. A great way to highlight this, and I have to give Purdue University credit for this, is they built a dashboard taking data from the Bureau of Labor Statistics and looking at wage rate growth. And remember, this is just average wages of U.S. consumers. It doesn't represent any one income group, but we're just taking averages overall. And then they take that basket of goods, right, and we can break that down into individual components that Bureau of Labor Statistics collects, and we can see what an hour of work in, for example, February 2020 would buy you for ham, pork chops, bacon, so on and so forth. You can see the pounds there that can be bought for 1 hour of work. If I cut to the chase here, September 2023, that same 1 hour of work, yes, wages have increased, but I told you that wages haven't increased as fast as all other goods. In this case, we can buy less of everything to the tune of 18% less ham, 6% less pork chops, 8% less bacon, and so on and so forth. Now, these are nominal prices here, so I'm not adjusting for inflation. And when we look at changes in pork prices here, we're seeing, and this would be USDA's composite price for pork, for beef, and for poultry. Overall, we've seen pork prices increase 9% from 2022 if I compare back to 2021. But if I look year to date, we've actually seen nominal prices down 2% through October. Or if I look at just October 2023 compared to October 2022, we see it's down slightly 0.1%. So the question is, if the impact of lower nominal prices, has that had any impact on demand? Well, first thing to decompose here is those are nominal prices. When we look at inflation adjusted prices, we're actually seeing pork prices down 5.8%. So if we're going to see demand hold or demand grow, we need to see per capita consumption increase. Now, unfortunately, per capita consumption is down 2.9% if I compare the third quarter of 2023 with the third quarter of 2022. If I put this together, use an elasticity estimate, my estimates are demand is down almost 10% year over year. We would have needed to see increases in pork prices, all else equal, increases in per capita consumption to see demand not change or actually increase. Now, when I compare historically, this is the sixth decline year over year, quarterly decline year over year in pork demand. And I want to highlight a few things when you compare these red bars over time. You can really kind of put them in four different categories. So we've seen the exceptional demand. If we look back to 2020, 2021, and 2022, those are responsible for the very strong hog prices that we've seen over the last several years, as supplies were relatively large as well. Then you can look at maybe a second quarter category of demand, 2019, 2017, and earlier periods in the early 2000s. You're in that mid-90s range for my demand index here. Now, currently, we're maybe in that third category at the 87 index here in the third quarter of 2023. Most recently, we kind of experienced the same demand period in 2018. And then you go back before that, 2014 and 2013. Now, it was a little different in 2014. Remember, we had relatively strong demand compared to historically at that point, but we also had a supply disruption in the form of porcine epidemic diarrhea virus, and you had this real risk premium in the market because we didn't know how big that impact would potentially be. And so that was both from a supply and a demand standpoint, really drove prices much higher. Now, really, I already hinted at what drove such strong demand in 2020, 2021, and 2022. A big part of that is we pumped a lot of money into the economy, roughly 40% in 2 years, if I look at February 2020 to March 2022. Now, that caused a lot of economic activity, as stimulus should in the economy, but now we're also seeing those debt levels continue to increase, right? So as you look at where household debt is, it's reached 17.29 trillion. The third quarter credit card debt continues to push higher. So as inflation, as things have cost more, they've impacted consumers, and it's impacted debt, and it's impacted consumer demand for many goods, protein, pork included in those basket of goods. Now, a bright spot when we look at demand has actually been export growth in pork volume. So as we look at year to date, so data from USDA's Foreign Ag Service through November 9th. They have accumulated exports up 6%. Point to a bit of optimism when you look at outstanding sales are up 42%. So total commitments right now are up 10% overall. Now USDA for the year is projecting a 6.1% volume growth. That's come down a bit the last couple of months as they've made their forecast. They're also pairing that with a 3.2% growth in 2024 over what we've seen in 2023. Now, breaking it down to individual countries, Mexico, for example, has been down 5% year to date. Outstanding sales, not much potential growth there is currently what's on the books, so about 5% lower. But when you look at Japan, for example, overall for the year, we've been down 4%, but a lot of outstanding sales. Some of that product will move here at the end of 2023. Some product will move into 2024, certainly. Same scenario when you look at South Korea. While it's been a 13% growth for the year, 110% for the outstanding sales. And then I think I'd be remiss if I didn't point to many countries that when you look at the percent share is relatively small. So take examples of like the Philippines, Vietnam, Chile, for example, relatively small share, but have seen notable growth on accumulated exports and significant year-over-year outstanding sales. So I think it is important to highlight that prices have certainly been supported or could be much lower if we hadn't had this supportive relatively overall export market. Now that's come in the face of what we've experienced is a strengthening US dollar relative to our foreign currencies of both competitors and customers. So that has overall bad for US exports. Now, the one I think we need to put it into context is Mexico has certainly strengthened over the last several years, but have weakened a bit in 2023. And so Mexico, where we've seen strong growth the last couple of years, it's maybe coming down from some of those heights that we've seen. Now, current forecasts, and these are from USDA's Foreign Ag Service, they're similar to what USDA and WASI, unsurprisingly. The similarity is we're expecting a 3% increase in 2024. Exports, they're expecting strong demand from Canada, Philippines, and South Korea, as well as gaining market share from the European Union in China and Australia, as we're seeing, impact in European Union of very high costs and what we've seen impact on their production. Now, in 2024, they're also expecting Brazil exports to continue to gain market share, particularly in Japan and Mexico. And, interestingly, they really called out the United Kingdom has the exports expected to increase 9% on lower input prices, higher pig prices. And this is going to help increase for export to the EU as well as into China. Now I'm going to cut to the chase here and provide some forecasts and then fill in where I think the supply and demand situation fits this or where we may see some changes in some of these forecasts. I'll highlight these forecasts are from 3 different entities. So the Livestock Market Information Center made their last forecast late October. USDA's Economic Research Service is a bit more recent in their forecast, November 9th. And then I'll highlight my forecasts are using the futures price adjusted for an Iowa, Minnesota basis. And that would be the all producer sold hogs. And this would be a date of last Friday here. And so when we look at 2022, these was the second highest prices ever compared to 2014. Also, these prices are all nominal. We're not adjusting for inflation here. There was actually a period, or quite a long period in 2022 that we were forecasting the highest prices ever, but we've seen a late year swoon in hog prices, and that brought us down to just under $100 per hundredweight and the second highest ever. 2023, I think it's safe to say at this point, as we have roughly about 6 weeks left or so of the year, that these will be the 7th highest nominal prices ever. Now, these are 16% lower than what we experienced in 2022, but the average nominal price of 81 still stacks pretty favorably compared to historical prices in the tune of about 7th highest ever. Overall forecast, maybe LMIC is the most optimistic, but forecasts are for maybe a little bit of growth, 2% or so in prices in 2024. Now, as I highlight, prices 7th highest nominally at least, receipts are relatively large. Maybe this is a bit surprising to some when we look at how profitability for 2023 and 2024 shapes up historically. So many of you are familiar with the Iowa State University model for fair to finish estimated returns. This is a barometer of returns. It doesn't represent any individual operation. It assumes no risk management, but it does kind of provide an apples to apples comparison over time. And when I make that comparison, really the year that stood out prior to 2023 was 1998, right? Where losses in particular months were below $60 per head. And when we averaged the year, it was about $27 per head. That was extended into 1999 at about a loss of $17 per head. Now I compare that to 2023. Actually, the 2023 annual loss is larger as forecasted currently. So that's using data through October plus forecast for November and December of about a $32 per head loss. 2024 be forecasting about a $16 per head loss. So as we think about the impacts of 1998 and the impacts that had on the pork industry, I think that does beg some questions of what the current financial situation and how that's going to impact potentially the structure of the industry. Now, one thing to highlight, I think, when you think about what came about because of 1998 was livestock mandatory reporting. So USDA started providing mandatory reporting by packers to help us have a better understanding of both prices and quantities of hogs in the marketplace. It took a while to get that program stood up, started coming online in 2001, but a lot of the data that I'm going to show you throughout this presentation was a direct result of 1998 and the situation that producers experienced, had people asking questions. Congress acted and instituted the livestock mandatory reporting. Now, one big change as we look at back to 1996 was we've seen over a doubling in the percent of hog inventory owned by contract operations, over 5,000 head, but raised by contractees. So we've seen a real increase in contract production, really stabilized maybe the last decade or so, but the last several years, we've actually seen this start to increase a little bit more, peaking at 52% as reported in the last Hog and Pigs report. Another change in the marketplace is how we discover hog prices. And I'll note here, packer-owned hogs from 2002 was over roughly a little over 15%. Today, it's a bit over 40%. A big part of that change came in the latter part of the last decade as we've seen significant investment in processing capacity, both by producers that now own packing plants, as well as packers expanding or adding processing capacity. Really jumped that from under 30% to over 40% today. Also, highlighting here, the increase in the other purchase arrangement category came part of the last decade. And I think we're going to see some of that moving forward as we talk about how we sell hogs and procure hogs as it relates to Proposition 12, as it relates to Question 3. That's going to change how some of those hogs are going to be reported, and I'll highlight that here in a few other slides. Now, if we want to think about some optimism about price forecasts, here is some latest forecast, would be in the pink line from USDA and those 10-year forecasts. And if I compare to their last two forecasts, or the Food Ag Policy Research Institute forecast early in 2023, these are some of the most optimistic 10-year forecasts, especially through maybe 2029 that these institutes have forecasted in some time. So while 2023 is much lower than what was forecast, there is potential, or at least some sentiment, that we will see stronger prices going forward compared to maybe what those expectations were the last several years. This doesn't say anything about profitability though. This is just looking at what those price forecasts are. Now, as we look at the balance sheet for 2023, we're looking at slaughter levels being up. These are Livestock Market Information Center forecasts. Slaughter levels up, looks to be maybe over 1%. Weights to be down, so production similar to 2022 levels. And then maybe surprising to folks is we're looking at forecasts to be similar production as we look at the years going ahead. So maybe not much growth, but also not much decline in that production. I think there's several reasons for that as we think about why we're not seeing the cut in hog numbers and production. Maybe that would be dictated by the financial situation. One is biological lag. So pork we're consuming today, decisions were made 10 to 18 months ago where the situation was better. But as we get further along, that situation looks much worse 10 to 18 months ago. So I think we will see some adjustments in production. Also, I think it's important to keep in mind asset fixity and specificity. So there's been tremendous investment in the pork industry from the production, the processing side of things, and we're not going to idle those production facilities in the short run because of this asset fixity and specificity. Last hog and pigs report, there wasn't too many surprises in here, but there is a few things I want to highlight because I think that dictates at least the short-term and medium-term outlook for the pork industry as it relates to what we're expected to see for supplies in the next 6 to 12 months or so. One is we look at current slaughter levels since September 1. They've been notably higher than what the hog and pigs report suggested or pre-report analysts expected. So actually, slaughter's been up almost 2%. Hog and pigs report had it up 0.6%. So the question here is, are supplies larger than USDA estimated? Have we pulled hogs ahead? So we're very current in those marketings, or some combination of that. I think some data answers it is probably a combination of those two factors. One of that is being weights. So we're seeing weights notably lower, especially when we look at packer-owned hogs. They're similar to the 2015 to 2019 average. This has come at lower feed prices as well for last several months. Now, that didn't impact the total bill for those hogs, but I think we would expect it, all else equal, to maybe see those hog weights increase a bit. Now, they have increased seasonally as well as when we compare to historic levels for producer-owned hogs, but they still remain below 2020, not surprisingly, but also below 2021 levels. So I think some indication that here we are relatively current in those marketings. We look at sows farrowing and intentions. I'll highlight here the next 2 quarters of intentions, September, November, December, February. Those were rather pessimistic for pork producers. This would be the lowest since 2012 and the lowest since 2014 for the December, February. Now, maybe not surprising given where current financial situation is, but when I pair this with the size of the breeding herd, that farrowing utilization rate or breeding herd utilization rate is rather low compared to history, where that would be for September, November. It would be the lowest since 1913 and 2003. And so there would suggest maybe USDA would revise the sow inventory lower, or producers would come in a bit higher when we look at actual sows farrowing. Could be a combination of both of those, but also I do highlight that we've actually seen the breeding herd utilization relatively low the last several quarters, as highlighted by the purple, the green, and the blue line. So it is maybe believable in the current context. Then we have to ask the reason, why are we seeing this breeding herd utilization rate maybe lower than we've seen it the last couple of years, and what's impacting that? Well, we've potentially seen some significant turnover as we look at the breeding herd. Sow slaughter for the year is up 7%. Through the summer, it was up much higher. I think you looked at since June 1 to a few weeks ago, it was up about 11%. Some may say, well, we've seen increase in Canadian exports of sows and boars for slaughter here in the U.S. But even after you adjust for that, because our sow slaughter is so large relative to the Canadian exports into the U.S., we're still up 7%. So maybe some of that turnover is impacting when we think about the productivity of some of these sows, at least in the short run. Also, I'll highlight the litters per breeding animal has plateaued, and you could argue even declined here. Reasons affecting that, and I'm not an animal scientist, not a veterinarian, so I don't want to speculate too much on what could be impacting this, but there's a laundry list of factors that could be impacting this productivity measure here when we look at litters per breeding animal. So that's where we've seen some of the productivity decline. So weights have really cooled off or somewhat declined year over year for parts of the year. You're seeing impacts on litters per breeding animal. But you also have to take into consideration changes in pigs saved per litter. So the last 2 quarters, we've seen very notable increases year over year. June, August was up 4.6%. That's a record as we look at increase year over year. I think you have to go back to 2000s or 1990 to see something year over year that large. And as well as the level of 11.61 nationally, it is the highest we've ever seen. So when you look at the graph on the left there, it had kind of plateaued, but now we've seen a notable jump here the last 2 quarters. The question is this short-lived for some reason, or is this a longer-term trend that we expect to see those large increases in productivity? If it's a longer-term trend, then you don't need as large of a sow herd to see increases in pig crop numbers, as we realized in the last Hog and Pigs report, because the larger productivity numbers in litters offsets the fewer number of sows farrow, and you can actually see growth in that pig crop number. So where do we see this potentially? Well, I'll highlight I think we need more information. Why I say that is when you look at some notable changes state by state, the last several quarters, I think it highlights some bigger structural changes going on in the industry. So, for example, we've seen in Utah significant decline in their sow herd, likely the least productive sows, because of changes in processing in California. That had an impact on their sow numbers needed, as well as the pigs saved per litter. So they actually seen a 30% growth from June, August 2021 to 2022. Now, Utah is relatively small to impact the whole national number, but I'll also highlight, for example, Texas there was down 15%, but we've actually seen them up 21% year over year when you look at June, August 2022 to June, August 2023. Also, the Missouri is important to highlight there, as we've seen closing or restructuring of farms in Missouri, likely, again, the least productive sows. We've seen growth of 14% year over year in the litter rates for Missouri. The question being, is that a short-term adjustment, or do we see those numbers, those relatively strong pig saved per litter numbers, remain as we go over the next several quarters, which also would suggest, again, you don't need as big of a sow herd to get the pig crop numbers desired. Now, disease has been relatively low. And so again, are we on a new trajectory for pigs saved per litter? I think if we remain at these relatively low incidence rates, that helps the potential to see those large year-over-year growths. I'll highlight here some data from Iowa State. Says maybe as we get into the fall here, there are some regions that are seeing maybe higher incidence rates than what we experienced over the last year. So that could temper down some of that productivity numbers. Early wean pig prices on a cash basis, so it'd be 10 to 12 pound pigs as well as 40 pound pigs. These are some of the lowest prices we've seen in a long time. You have to go back to 2016 to see prices at this time of year this low. I think it's important to keep in mind also what was going on in the fourth quarter of 2016. There was a real processing constraint in the industry. So before we added a lot of the processing capacity that we did, and that really brought down lean hog prices, but also brought down wean pig as well as feeder pig prices. And so while we don't necessarily have that capacity strength now, we have constraints on profitability, which has really brought down where we're looking at both 10 to 12 pound pigs as well as 40-pound pigs. Now, we talked a lot about the revenue side of things so far, and maybe that prices, are still compared to historically, at least nominally, not all that bad. But we also need to very much highlight the cost scenario. So costs have increased roughly 50% since 2020, and entered really a new era for prices. So as we look back to 2013, the average there was $90 per hundredweight. We've reached $97 per hundredweight. That could be higher for some producers, lower for some producers. But also when you look at 2024, where grain prices are expected lower, maybe it surprises you that we've only expecting about an 8% decrease in total cost. A big part of that is all the other costs beyond feed costs. So here I'm using some USDA estimates for various costs. Feed grains, for example, are down 37%. But look at all the other costs that are helping maintain those costs of production and keep costs of production relatively high. Also, those costs are here likely to stay, and we're not likely to see much easing, if at all, in a lot of these other costs that are highlighted. Interest rates are as high as going back to 2007, the second quarter. And as we think about how the Fed is going to deal with continued inflation above the target rate, do we have some more interest rate hikes in store? We also are dealing with a considerably tight labor market. 3.9% was the current unemployment rate. If you're looking to hire someone, I've used this statistic before in September 2023, don't expect to hire or expect to hire less than one person. So unemployed persons per job opening is 0.7 currently, and has really remained at those very tight levels. So profitability, as we look at 2023, 2024 again, is going to be potentially the worst year stretch or worst 2-year stretch ever for pork producers. Now, I want to talk about why we've seen a little bit of variability and maybe some of those returns for producers. Now, the estimated manure credit, so if we look at it more broadly, the value of that manure is both a crop production potential to decrease the fertilizer bill or a credit for the hog operation. We've seen that manure worth a lot more as commercial fertilizer prices have increased. But that value has come down significantly, and we've seen margins for pork producers still very much in the red, right? So as we've seen commercial fertilizer prices in 2022 go up to historic highs, we've seen that manure credit worth $12 per pig. Now it's more in that $6 range as the estimated returns estimate. Now, as we look at where the market was offering prices throughout the last year plus, we can think back to late 2022, early 2023, there was much more optimistic prices as we looked at the futures market and the ability to offset the risk of lower prices in the form of hedging, using the futures market, using put options, using something like livestock risk protection, maybe allowed producers to lock in something closer to break even or slightly below break even annually for the year, compared to what we're experiencing now, roughly a $32 per head loss if we look strictly at what the market has offered each month over the last 10 months plus forecasting the next 2. Similarly, 2024, though, the market hasn't currently offered much at all of profitable prices. There's a few months during the summer, if I jump back here, that potentially we're seeing $10 returns or so, but overall for the year, not much opportunity to lock in profits. Now, as we look at this is the February contract, we've seen some strength in prices as of late overall, at least since late October. If you look at some technical indicators here, some moving averages, maybe as of late there was a buy signal in the market as we've seen the 9-day, 18-day cross that 40-day moving average, which would be suggestive that prices could continue to strengthen over the next couple of weeks to months potentially as we look at where that February contract is trading. Where that would be, though, is on the lower portion of this cycle of market emojis. And so as you think about where prices have gone this year, we're much more in that point of maximum financial opportunity than on the top of that price curve. So what does that mean? Well, there's opportunity because prices are much lower than they've been. And so I think here is, as we think about risk management opportunities, if we do see a rally in prices, producers need to be in tune to potential opportunities to offset some of that risk going forward, especially when you think about the cost of production, right? So as feed prices have come down, we're still expecting those elevated costs of production. Now, we know that prices producers receive are very, there's a wide distribution potentially on there. This is a particular day a week ago compared to a year ago. Distribution that last week was at 60 to maybe 100 plus. Part of that is how those or why that's the case is how those hog prices are discovered. I want to highlight the other purchase arrangement. That's on the right tail there as we look at this log normal distribution. Those are some of the higher price. There are also some of the higher cost hogs to produce as well. Now, USDA does provide a little bit of data on there. They provide the non-carcass merit premium report, and you'll see a wide variation there from the low end to high end range. It was as high as $30 per hundredweight. We've seen maybe that unicorn premium no longer available in the market. But overall, when you look at a weighted average, it's been in that $4 to $5 range for a weighted average. Now, brand new news, and USDA does not have the report out yet today, it'll probably be out later today, is they're going to start releasing as part of that non-carcass merit report a separate category. So you can see categories from volume for pork quality assurance for that other category. They're going to break out one, and it's for animal confinement legislation. So right now, that other category is animal welfare, antibiotic free, diet, feed, genetics, quality, process verified, sow housing, and weight. Now there'll be a category taken out for animal confinement legislation. According to them, there's large enough volume there to report that without being concerns about confidentiality. But they're not going to report the volume. This is only a price metric. So it's a price range and an average price. It's not the volume of hogs that are receiving that non-carcass merit premium. On the pork side of things, they do report a bit of data when we think about where the specialty pork is. So specialty pork, it's an aggregate again, has increased maybe in that 6 to 8% range of total pork being sold. But it's much higher for certain particular cuts. And so when you think about the loin, the rib, the belly, those percentages are 10% plus of the total volume of pork. The one thing to keep in mind here is those products are likely easy to sell at a premium, right? Loin, rib, belly, likely could sell at a premium. But think about all the other products that it's going to cost more to produce that hog, but also you may not get the premium for those products. So that means the rib, the belly, those premiums have to offset the whole cost of producing that pig at a higher cost. Pork cutout values have been lower than year-ago levels, especially for the first half of the year. And now we've seen assume that cutout value. It's really followed the plight of the belly. So when we've seen strong belly strength this summer, we've seen relatively strong pork cutout values. Spring, fall now, we've seen weaker belly, and you've seen what's done to the cutout. But also the ham has been notably lower. As we look at exports to Mexico, has certainly impacted ham prices as currently what the cutout's reporting. Pork in cold storage remains at historically tight levels, down about 14% for this time of year, or at the end of September here. If we compare that to even in 2020 when we were really pulling on those inventories, we're at those levels currently. Interesting when you compare year over year and month over month. So year over year, ribs down notably. I think as a lot of that pork in inventory has moved to California because if it was in inventory, we could still send the product to California. Also, when you look at month over month, though, we're seeing some changes. So their ribs are up, which would indicate maybe a lot of that product, has been moved already, and we're seeing those tight supplies relatively tight in inventory. Now, packer margins, I think important to highlight these kind of at different levels. So here, as I look at a net margin, so think about what a packer could go out into the open market and buy hogs for. Those margins are currently roughly at break-even levels. Now, early part of the year, before we seen that swoon in hog prices, they were below break-even for packer margins. But also look at the integrated net margin. So here, what I'm using for the price of hogs is really what it costs to produce a hog. And so in that case, integrated margins have been notably lower, down maybe $70 per head as we look at springtime of this year. We did see some appreciation in those margins, but now again, they're back down to maybe losing about $30 per head. Now, some of that's on the pork cutout, right? As we think about pork cutout, hasn't been as strong as last year, especially, but also the cost side of things. So just as it costs producers a lot more to produce, it costs packers more to produce. And it's not just the hog price, right? It's the cost of everything else. It's labor, it's energy, it's whatever to keep the lights on and move that processing capacity is costing more. And so we're seeing that impacted here in current packer margins. We've seen some changes in processing capacity. So if you date it back to fall of 2021 to fall of 2023, we've removed roughly 4.5% of national processing capacity. Now, I know there was an announcement for that Windham, Minnesota plant to be reopened potentially this spring, which would add some capacity back to this situation. But overall, we've removed capacity not only in the United States, but also in Canada as well, as there's been announcements of Olamil and High Life reducing processing capacity in Canada. So I'm going to end with that to give us here a few minutes of questions. I'll highlight a lot of what I discussed today is readily available at a lot of the websites that I highlight, notably the estimated livestock returns, as well as my current outlook for the pork industry can both be found on Wallace's Farmer as well as the Egg Decision Maker newsletter website. So thank you for your time, and I look forward to any questions that you have.
Perfect. Well, thank you, Lee. You got through a lot of information in a very short time. So I'm sure everyone, with their questions, they feel free to add to the chat. But we'll get those started.
So Zoe, the longer I talk, the less hard questions I get, right? So
That's true.
You could argue maybe I didn't do a good enough job delaying this a little bit, but more seriously, happy to take any questions people have.
Perfect. First one being, what is production, or how is production in other countries such as your Canada, Germany, China? What has that kind of been looking like?
Yep. So, overall, we've seen a contraction in production in European Union, for example, but we've also seen a lot of improvement in profitability compared to at least how bad it got for the European Union. So there's ongoing adjustments, right? So, China as well, as they continue to expand production from African swine fever impact, both from a, disease impact, culling strategies they've had, but then really over maybe populating and then seeing impact on prices and then reducing some of that production. So there's a lot of dynamic adjustments going on. Cost has been a big factor driving that. And that's part of the reason why we've seen stronger exports maybe from the U.S. than expected, right? Even though we're all dealing with higher costs, the U.S. still remains a low-cost producer, right? It's really the U.S. and Brazil. Now, Brazil, they've had an advantage of their depreciation of their Brazilian real relative to the U.S., so that's made them a bit more competitive. But that cost scenario has helped us on our export front. There's going to be some rebalancing, right? As we've noted, profitability in other key hog production countries, regions of the world. We'll see some increased production there. Brazil continues to grow and potentially take market share from the U.S. So again, a rebalancing, but overall it has been optimistic, and I think some of that will extend into 2024 as well.
This one could have two parts, but is inflation causing consumers to change their meat purchasing selection? Then maybe a follow-up of, do you see the retail pork margin increasing, decreasing, kind of?
Yep. Yep. So good question. The first one, I think there's a couple parts to that. So I'm a geeky economist, right? Price is impacting quantity demanded, not overall demand, right? And so as prices increase, we expect consumers to eat less pork, right? But you're having a higher price to offset that decreased pork consumption, and vice versa, right? So that's how price is impacting. Now, where we've seen the biggest impact is on consumer demand, I would argue, is when you think about consumer incomes, right? So consumer incomes 2020, 2021, 2022 drove really strong demand for pork and a lot of other goods, right? As those consumer incomes have tightened because of inflation, consumers have had less dollars to spend on pork and other goods, right? And that has impacted pork demand there. Now, as we think about that retail spread or the spread between, we could do all three spreads, right? So look from producer to packer to retail. So that spread is supposed to, and in the long run, does dictate or does really manifests itself as costs, right? So as we think about costs have gotten larger, right, we would expect those spreads to widen. And that has by and large happened because of those increased costs. Now, also, I think it's important to keep in mind shorter term impacts, and I think maybe that's where some of the question is, does competition kind of impact some of that, right? And so as you think about where we currently are, I mean, supplies are relatively large for pork, right? Seasonally, as well as just cyclically here. And so there is a situation where, I think we're going to see hog prices potentially bid down or stagnant relative to what you could push off to consumers. Now, if consumers are unwilling to pay those higher prices, that could keep that spread relatively narrow or not allow it to grow as much as maybe some people have seen it grow the last couple of years.
Okay. Do you have numbers on Canadian pigs harvested here in the U.S.? Has it increased year over year or?
Yep. So the one I showed was sows. So yes, sow numbers, I think if you look since June 1, sows and boars are up about 7%. I believe if you look really across the board, we are up both in live animal for slaughter destination as well as feeder pig imports. Not as of late, so we've seen those feeder pig imports not as strong as of late. Maybe not surprising given where prices are for feeder pigs. But for the first part of the year, we did see notable strength in those Canadian exports or U.S. imports of live animals. That's multifold, right? So think about from a currency standpoint, strong U.S. dollar makes us give us a little more purchasing power for those pigs. Also, as we've seen reduction in capacity of processing in Canada, that's pushed more hogs south as well. And Canada's not immune to the cost inflation that we've seen here in the United States. So they're dealing with much higher costs and issues with profitability. So that has driven, I think, more production here potentially, or has drawn more potential, and I think has the more potential to continue to drive production here.
Lots of good questions coming in. Do you track equity loss by producers? And at what level do lenders force downsizing of the industry?
So I do not track that. That would probably, that'd probably be out of my wheelhouse to certainly to forecast. I will highlight here, I think, when we compare 1998 and 99 to the current situation, I think producers are in a much better financial position. I want to put the caveat there that, this has eroded a lot over the last several months and year here, but we may have entered this scenario maybe a bit better than we did back in 1998. So maybe that we don't see the large structural changes. Also, the industry is much different structurally than it was back then. So maybe we don't see the structural changes that we do see. The downsizing, at least, that is what a lot of the current estimates or forecasts are. I'm not saying that they're right necessarily, and I'm not willing to make my own forecast necessarily of production numbers going forward, but current estimates would suggest there is not going to be much contraction or downsizing of the herd. And what we do see as contraction is offset by increases in productivity, right? So if we do continue to see pigs saved per litter, for example, increase at the rate it has been, we actually would see more pigs potentially on the market.
Perfect. That helped answer one question of impact of more pigs per litter having on production, and discuss the decreasing of inventory of sows due to that. But another one of, do you think we should worry about processing plants closing?
Sure. I think there's been some, I think we may be past the worry, right? As we've seen some plants closing, and ongoing adjustments in some of those plants. That's broader than the U.S., right? So we highlight, we've seen some adjustments in Canada. Also, as we think about if we do see contraction, going back to I'm unwilling to make that forecast, but if we do see contraction in the sow herd that does lead to tighter numbers, maybe we don't see the continued impact of productivity. So that means that we need less shackle space, or that excess capacity, does rear itself, and the highest cost producers, or packers in this case, would be the ones, at risk first in that scenario, right? Again, I think we've seen a bit of rebalancing already. As you look at current hog numbers, though, I think we're actually in a pretty healthy spot, just as you think about where the shackle space is relative to the hog numbers. Now, that's a really ongoing pursuit or adjustment to really match those numbers, but there doesn't, to me, appear to be a lot of excess capacity, and there doesn't appear to be a capacity constraint. Fourth quarter, and we're going to enter the next several weeks, are going to tell us that, right? The one caveat I'd put on there is I'm talking about physical capacity. Operational capacity is a totally different thing, right? So as we think about a tight labor supply, as we think about chain speed adjustments, possibly that could change what that processing capacity is relative to the hog numbers. And so, yes, I think certainly, there is a risk potentially of adjustments in processing capacity, more than the ongoing adjustments we typically see.
Okay. Well, thank you, Lee. That was the last of the questions in the chat, but by all means, if there are any questions, please feel free to reach out to me or Lee himself, and has a few links there to help answer some other questions as well.
And I'll end with wishing everyone a safe and happy Thanksgiving break. And please eat lots of pork. I know the Schulz household, pork will be at the center of the plate for Thanksgiving. And so please do that, and please, reach out if you got any questions, and happy Thanksgiving.
Yeah.
So there was one more question, Zoe, if you want to take a look at the chat. Sorry.
Oh, okay. Does the ISU fair to finish cost of production data represent the average producer? I've heard before that it would probably underestimate the cost of production and therefore the profitability of the average producer.
So there's debate about there. I'll argue, from my side of things, I try to keep it as representative as possible, but that's an ongoing challenge, right? We know that, cost structures of producers vary across there. And so, especially as we've seen adjustments and higher costs and inflation, keeping up with some of those adjustments are a challenge. And so, I've heard some folks say that it does represent maybe some of the lower cost producers. And so, again, as I alluded to in those estimates, I think the bigger issue, or the bigger thing to hone in on, is that barometer over time, right? So think about how, if you're going to benchmark against your operation, how does that change over time? Your operation may be 10% higher cost, your operation may be 10% lower cost, but does it track with that overall change kind of over time? I think is really the important thing to highlight there. And that both also comes from a cost, but also a revenue side of things too, right? So The revenue series that I use is the negotiated, the swine and pork market formula, and the other market formula. I don't have the other purchase arrangement hogs in there. Remember I showed you that graph? Those are some of the highest price and highest cost hogs. So in that sense, if you think about my revenue price, that may be very representative of the hogs to produce that. If I'm not including that other purchase arrangement, which is a sizable and growing quantity of hogs that are going to be represented in the U.S. And so, but always happy to take feedback on that estimated returns. I know that it's a highly used instrument in the marketplace. And again, I want to be as representative as possible to represent producers' costs as well as their returns.
Perfect. Okay, well, with that, like I said, this will be recorded and we'll find a way to get that link out to you guys if you want to review it again or share it out. So for that, thank you, Lee, and thank you, Stacy with Iowa Pork Industry Center for helping put this on. And yeah, have a good Thanksgiving break.
Thank you.